While most investors saw panic, the smart ones saw opportunity. Because when volatility hits, it doesn't just shake out weak hands, it creates rare entry points into high-potential plays. On July 11, 2025, news broke that the Trump administration plans to impose a 35% tariff on Canadian imports, an explosive development that sent shockwaves through Wall Street and the broader North American economy. Stocks across the board tumbled, and the mood? Pure uncertainty. In today's video, we're spotlighting three AI tech stocks caught in the market's crossfire. One is a voice AI disruptor, down big but possibly poised for a massive comeback. Another is deeply woven into North America's supply chains, quietly commanding strength. While the third stock? It's already riding the AI wave, yet still flying under Wall Street's radar. Could one of these be your next breakout winner? Stay tuned, because the real opportunity isn't where the headlines scream. It's where smart money is quietly moving next. But before we go in, if you find value in content like this, hit the like button, share with others hunting for hidden gems, and subscribe so you don't miss future plays. Note, this video is for informational and educational purposes only. It does not constitute financial or investment advice. All right, starting with the first pick, SoundHound AI, ticker symbol SOUND, the next NVIDIA, or just noise in the AI. Boom! As artificial intelligence continues to reshape industries, NVIDIA has reached historic heights thanks to its dominance in GPUs. However, behind this $4 trillion giant, the most valuable company in the S&P 500, another player is gaining attention in the AI boom. SoundHound AI Inc. Zero, a rapidly expanding voice AI platform, outperformed NVIDIA in share price gains last year. So, can SoundHound stock become the next big breakout in the AI surge, or is it riding the hype wave too aggressively? But first, let's know what exactly is driving SoundHound AI's momentum. SoundHound AI has experienced a remarkable 211.6% increase over the past year, surpassing most of its AI competitors. The main driver of this growth is the rising demand for its voice AI solutions, which serve industries focused on efficiency, automation, and delivering quick customer service. In Q1 2025, SoundHound reported revenue of $29.1 million, a 151% increase year over year. For the full year, the company projects revenue between $157 and $177 million, nearly doubling from $84.7 million in 2024. With a $140 billion total addressable market, TAM, and a $1.2 billion backlog in bookings, the company is establishing a significant niche. Despite its strong top-line growth, SoundHound AI remains unprofitable, reporting $188 million in losses over the past year. In comparison, NVIDIA achieved a 51.7% net margin, underscoring its status as a profit leader in the semiconductor industry. SoundHound also lacks the scale-based advantage that NVIDIA has, especially its GPU dominance. However, the voice AI company is heavily investing in R&D to develop next-generation conversational AI and integrate it into automotive, healthcare, and retail systems. Interestingly, despite being removed from multiple indices on June 30, 2025, SoundHound gained 43% over the last quarter, fueled partly by strategic alliances. Collaborations with Alina Health and Tencent Intelligent Mobility improved investor sentiment. It's the Polaris model, and expansion into voice commerce indicates long-term revenue potential. Over the past 3 years, SoundHound has achieved a total return of 263.14%, outpacing both the S&P 500 and the software industry. However, its reliance on partners and high development costs remain risks. Zacks currently rates SoundHound as a rank number 3 hold, with consensus expectations indicating an 84.6% year-over-year increase in fiscal year earnings. However, the company is not expected to become profitable in the next 3 years. Looking at our technical analysis of this stock, where's it headed? After peaking above $25 in December 2024, SoundHound entered a downtrend, but has since formed a rounded base between $8 and $14, indicating quiet accumulation. Please take a look at the support levels between $10.50 and $11. There are repeated bounce zones, then $8 a key is a potential long-term floor. Recently, there have been rejections at resistance zones of $13.80, $14.50. The midterm upside target is over $1,700. The current pattern looks like a bullish cup and handle. A break above $14.50 on higher volume could push the stock towards $16 to $18 in the near term. If macro conditions stabilize and the AI story gains strength, SoundHound might aim for $18–22 over the long term. However, the main point is that SoundHound AI has strong growth potential in a niche area of AI. Although it doesn't have NVIDIA's profitability or market advantage, its revenue growth, voice-first platform, and partnerships indicate long-term potential. But let's be clear, this isn't a blue-chip AI investment. It's speculative, volatile, and best suited for investors with a high risk tolerance and a long-term perspective. Could this stock be on your watch list? Let me know in the comments. And if you find value in deep dives like this, hit that like button, subscribe, and share with others exploring the AI frontier. Moving on to the next stock on the list, Vertiv Holdings, ticker symbol VRT, isn't your typical tech stock. This company provides the infrastructure that supports modern AI, from data centers and telecom networks to high-efficiency power and thermal systems. As the demand for AI computing power surges, so does the interest in the companies quietly enabling it all. After an intense session, Vertiv closed at 123.30, up 2.58%, outpacing the broader market and tech sector. Over the past month, VRT has gained 11.9%, easily surpassing the S&P 500's 3.85% increase. But is this surge just short-term momentum or the start of a long-term trend? First, let's take a proper look at the earnings and growth outlook. Vertiv recently reported a trailing 12-month order growth of 20%, with Q1 orders up 13% year-over-year and 21% sequentially from Q4. The company is expected to report Q2 EPS of $0.82, a 22% year-over-year increase on $2.28 billion in revenue, up 16.5% year-over-year. Full-year expectations remain strong, EPS of $3.56, revenue of $9.52 billion. Year-over-year growth, 25% EPS, 19% revenue. In short, demand for Vertiv's infrastructure solutions, especially in AI-heavy workloads, is increasing, and it's reflected in the company's top and bottom line. Vertiv recently announced a groundbreaking partnership with NVIDIA and iGenius, now Domin, to launch Colosseum, one of the world's biggest sovereign AI supercomputers, powered by NVIDIA Grace Blackwell superchips. This project will be launched in Italy in 2025, serving highly regulated industries such as finance, healthcare, and the public sector, with a focus on energy efficiency, data sovereignty, and AI performance. This isn't just a promotional piece. Vertiv is deepening its involvement in AI infrastructure on a national level, which is expected to boost its stock significantly over the long term. Meanwhile, Amazon Web Services, AWS, has introduced its liquid cooling technology for high-performance GPUs that Vertiv also supports. This caused Vertiv's stock to drop 11% in a single day. Here is why it matters. Vertiv's liquid cooling accounts for more than 10% of total sales. AWS is a major hyperscaler, and its pivot could impact long-term growth assumptions. Still, it's worth noting, most enterprises and smaller players won't build custom solutions like AWS. They'll buy Vertiv. After dropping from $150 to $60, VRT formed a double-bottom base, a classic bullish reversal pattern. Since then, the recovery has been consistent and impressive. There has been a strong rebound from the 70s, with prices clearing $100 and currently consolidating above $120. Key levels to watch: $125 to $130 with minor resistance, $145 to $150. All-time high, primary resistance. Break above $130 with volume could send it sprinting to previous highs. Volume trends also show increasing accumulation, signaling potential institutional confidence. Vertiv currently has a forward PE ratio of 35.3 compared to the industry average of 20.1. Its PE ratio is 1.25 versus the industry average of 2.18. Yes, it's a premium, but this reflects growth at a reasonable price, in a sector experiencing multi-decade capital expenditure trends, especially in AI and edge computing. Is VRT a buy? Vertiv isn't your next big 10x moonshot, but it could become your next reliable, steady grower. With AI infrastructure demand continually rising, Vertiv is well-positioned to ride secular growth trends in data centers, AI, and telecom, expand margins as scale improves, deliver predictable earnings in an unpredictable market. Risks to watch: macro volatility, especially rate hikes, and cooling innovation from hyperscalers like AWS pose risks. Dependency on a few major clients remains a concern. However, with a diversified global presence, a cutting-edge product portfolio, and deep integration with AI leaders like NVIDIA, Vertiv continues to be one of the most compelling under-the-radar AI infrastructure stocks. If the stock breaks above $130 with volume, It could signal a strong move further toward $140 or $150 and beyond. So, is Vertiv on your watch list? Would you buy, sell, or wait? Share your thoughts in the comments below. And if you found this helpful, hit the like and subscribe buttons. Alright, next is Paysign stock ticker symbol PAYS. In a year dominated by mega-cap AI hype, Paysign, a $460 million small-cap fintech, has quietly exploded, climbing 160% year-to-date and recently hitting a new 52-week high of $7.85. Currently trading at $7.85, the stock is showing signs of both technical strength and fundamental acceleration. But is this rally justified, or just another fleeting micro-cap momentum trade? What is Paysign? Paysign isn't trying to reinvent the financial system. Instead, it offers prepaid card programs, patient affordability solutions, and payment processing for healthcare, pharma, and government sectors. Its most significant revenue stream? Data processing, which generated $63.8 million last year. What makes Paysign compelling is its narrow vertical focus, specifically leading in payment logistics within compliance-heavy sectors. The company recently expanded its plasma donation network, now holding approximately 50% market share in that niche. Looking at the fundamentals behind the growth of this stock, this isn't a meme-fueled run. Paysign is showing real business momentum. Revenue growth exceeds 35% year-over-year, with gross margins above 50%. Projected earnings increase by 121% this year, followed by another 54% next year. High insider ownership and recent insider purchasing in the past 3 months. Analysts are also noticing this. The consensus is a strong buy, and the future outlook predicts 28.7% annual revenue growth, almost twice the U.S. market average. The company is still small, trailing PE of 72.8, but investors are betting on continued earnings expansion. However, these risks are offset by strong execution, a clear moat, and macro tailwinds in health tech and digital payments. However, the question remains, is Paysign stock a good buy? If you're a long-term investor seeking undervalued fintech growth, real earnings with scalability, insider confidence, and smart money interest, a niche moat in compliance-first verticals. If management continues to perform well, this could become one of 2025's stealth fintech success stories or the next NVIDIA. Is it on your radar? Would you wait for a pullback or ride the momentum? Let's discuss these stocks in the comments, and if you find value in this video, don't forget to like, share, and subscribe for more market insights.